Day, but we're going to end it with a bang. And again, my name is Steve Lawrence. You've seen me before. I'm with the Wayne School of Business, and it's my great pleasure today to introduce a good friend of the University of Technology and of Entrepreneurship. Jim Linfield is a partner with the law firm of Cooley and is in their business department. He's the partner in charge of Cooley here in Colorado and joined the firm in 1993, so he's been with the firm for a good many years. His practice focuses on technology companies, venture capital funds with an emphasis on corporate finance, mergers and acquisitions, and strategic alliances. He's worked with startups, venture-backed companies, public entities, investors from a wide variety of industries, including biotech, medical devices, information technologies, clean tech, renewable energy, organics, and so forth. So a wide range of entrepreneurial companies here in Colorado. He's a frequent speaker on financing strategies for emerging companies, corporate governance, and public security matters. He's going to speak today with us on financing renewable energy companies. He, again, is a great friend of the university. He's been a trustee of the university foundation, the fundraising arm of the university, and is very active in other parts of the university as well as with the state government here in the state. As far as background, he has his JD from Harvard Law School and his undergraduate degree from Harvard College, both magna cum laude. So indeed, it's going to be a pleasure to hear what Jim has to say today. So please join me in welcoming Jim.
Okay, thanks, Steve. Can you hear me okay? Yeah. All right, well, it's a delight to be here today. So I'm going to talk a little bit about how the ideas that you'll come up with, or the people that you work with come up with, will turn into companies that will turn into commercial products that will make a difference. And the way I look at renewable energies is, we're dealing, the energy market is the largest market in the world, largest segment of the economy. It's, overwhelmingly dominated by fossil fuels today, and if we're going to make a difference in that, it's going to require massive investment and massive new technological change, and that in turn is going to require tremendous amounts of capital to be invested. So I'm going to talk a little bit about kind of the how early stage companies, new technologies get financed so they can sort of make the progression to commercial deployment. And my primary focus is going to be on kind of the earlier stages. So I'm not going to talk about how you raise the money to build the $10 billion solar arrays. That's sort of a different realm. It's going to be more the financing that goes into startup companies that to fuel their proof of principle, the development, continued development of the product, initial commercial, manufacturing scale, and so forth. And I'd like to keep this informal and interactive. So if you have questions as we go along, feel free to raise your hand. I'm not going to assume that anyone has any prior corporate finance knowledge, so try to keep this, fairly high level and try to stay out of too much sort of technical jargon, right? So as I mentioned, the focus is going to be on financing the development of new technology. So, and just to contrast that with deployment, in the solar area, I'm going to be focusing on the financing of the development of perhaps a new technology, a new type of a semiconductor stack or something like that one would use for a solar array, or perhaps in the wind area, a new wind generator design, or in the biofuels area, perhaps a new genetically engineered mechanism for creating biofuels, as opposed to kind of the commercial deployment of those. And again, the focus is going to be on the technology innovators as opposed to big companies. So, GE or whatever, we're not going to talk about how they raise their money. So this kind of illustrates the financing challenge as you bring things to market. And a few comments here. One is, you see the capital requirements as the company progresses grow exponentially. This is a log scale on the right side. So whereas it may take a few $1 million to invent something, it will take tens of millions of dollars to complete the development of that and begin pilot scale manufacturing, and then hundreds of millions of dollars potentially to begin to manufacture at a commercial scale, and then perhaps $1 billion or more to get to large scale manufacturing, and then ultimately the deployment requires tens of billions. So Again, this varies from industry to industry, but this kind of is order of magnitude about right for this. And as a company progresses in time through these stages of development, it will access different types of financing. So lots of times, in very early stages, you'll be relying on grants. It could be a SBIR, which is a Small Business Innovation Research Grant, the federal program. Other types of grants, the DOE has, at least in the past, has had some grant programs. We'll talk about the future of those in a second. And maybe some seed capital from individual, small individual investors that decide they want to take a flyer on a new technology. As the financing needs grow from the millions to the tens of millions, companies end up turning to the venture capital community, which has played a very important role in helping some of the clean technology companies advance their technologies. And I have some slides later on that will talk about sort of the order of magnitude of their investment. The venture capital investors are taking an equity stake in a company, meaning that they get a share of the upside, and they also, run the risk of losing everything if the company doesn't succeed. So these are people that will look for the potential to earn a multiple of their investment. They may want to get 5 or 10 times or 20 times their money back if a company's successful, and if things don't go well, then they get nothing. And there's potentially some grants available at that stage. And as companies get into the scale-up, they may still be able to access some venture capital, may look to private equity funds, which are kind of further up the value chain here. They tend to have larger amounts of capital to deploy and less appetite for risk. And strategic investors play a very important role. That's really a term to refer to large companies. So Dow Chemical, for example, enters into strategic partnerships with some earlier stage biotech companies. One local example is OPX Biotechnology. GE has been very active in that space. So these are large companies that seek to partner with the technology innovators and bring the significant capital and scale-up experience to bear to help move technologies along. And then when you get to commercial financing, commercial scale production, you may be again looking to some of the strategic investors. Maybe if a company has gotten enough risk out of its product, you might be able to borrow from a bank, maybe able to go public. So as you move across here, the dollars go up and basically investors' appetite for risk goes down. So you have to take risk out of the technology by proving that you can produce it consistently, reliably, at a cost in line with your estimates in order to convince people to put more and more amounts of capital risk. The questions on this, we'll delve into a little more detail. This is sort of a big picture on this. So there's a lot of challenges in financing renewable energy technologies. And the availability of capital tends to be quite cyclical due to all kinds of things happening in the world. So conventional energy prices. Steve was just asking me about what's the impact of cheap natural gas on renewable energy technologies, and it's it has upset the calculations of a lot of people that were made a few years ago because nobody saw it coming. At least almost nobody saw it coming, and it makes it tougher for the math to work out for a lot of these technologies. The capital markets vary based on all kinds of factors. It was very hard to raise financing for anything at the end of 2008, 2009 after the crash. If you had been counting on access to capital to scale manufacturing, you'd have been in the world of hurt back then. But these things go in cycles. In the renewable energy area, government policies play a very important role. Many of these technologies are not commercially viable without subsidies. So you look at ethanol, for example, or in the case of solar, Germany became the largest solar market because the government decided to institute a feed-in tariff. They did that incidentally in an area whose solar footprint is about the same as Alaska. So it obviously required huge amounts of German taxpayers' monies that had to be expended for that. And I think at some point people lose patience with that. But that's one of many examples of how government policy impacts this. Availability of government grants and loans. So that is again determined by politics. So all of these things are the part of the entrepreneur's challenge as they think about a financing strategy. Is they have to deal with potential surprises and changes in these things, and that in turn means you need to build some flexibility into your planning to deal with that. And it may be some of these may be company killers. Things. If you built your entire business plan on the assumption that there would be a feed-in tariff and it goes away, then you may be out of business. If there's a dramatic decline in prices for solar panels because of competition from China that hadn't been anticipated, it's put companies out of business. So this is part of the challenge of the entrepreneurial environment. So what we've seen in the last few years is kind of what's illustrated at the bottom here. So a tremendous amount of excitement really at the beginning of the Obama administration with some of the new subsidy programs and grants and DOE loans and so forth. Part of the effort to make renewable development of clean technologies a centerpiece of their economic stimulus program. That led to a lot of investors jumping into this space, thinking that this would be a great growth opportunity. As is often the case with our capital system, you end up with overinvestment in this, and a variety of factors cause a number of business failures. What you hope you get out of that are some survivors that go forward. But it can be a brutal Darwinian process of determining which companies survive. The good news is that as a result of the initial investment, there was a tremendous flow of human capital into renewable technologies, and a lot of really smart people from biotech and material science and chemical engineering and semiconductor industry flowed into this area and made tremendous technical progress in a lot of areas. Not all of those companies will be successful, but I think there will be enough that through this process emerge that will make a real difference. So I sort of divided these things into a couple of buckets, the things that you can't control and the things you can control, because it can be a little intimidating when you think about how you're going to finance a company to look at the list of all these things that could change and upend your plans. So the things you can't control, obviously, are things like fossil fuel prices and politics, government policies. Each election sort of brings a new sort of tenor as far as the Congress's and the President's appetite for these kinds of things. The stock market, of course, has its own mind. Actions by competitors. We've had one of our clients, their arch rival has been trying to put them out of business by suing them in patent cases. And the overall economy. But there are things that a company can control. They can control the quality of the team they put together. And as you think about potentially going to work for an innovative company, that's really, really important to look carefully at the quality of the people there, because with a good team, you may have the ability to survive some of these surprises, and with a less skilled or experienced team, your risk is certainly higher. Company strategy, controls its strategy and can devise a strategy that may help it navigate this. I'm working with one solar company that's developing a new form of thin film silicon PD panel, and they have built their entire business plan on the assumption that there'll be no tax credits, no subsidies, and no government assistance of any kind. And they think that they can produce their panels at a cost that will still be competitive. So in that case, they have taken some areas of risk out of the equation by simply assuming that some of the things that other people are counting on won't be there. Obviously, it raises the stakes technically for them because they've got to be right that they can get to 42 cents a watt. But if they get there, they've got a pretty nice business, notwithstanding a lot of other things that might go wrong. For every company like that, there's a lot that have built their strategy around the assumption that there will be subsidies or tax credits or feed-in tariffs, and those companies are obviously more at risk for changes in government policy. Something that it's very hard to get visibility on as you interview with companies that you might want to join is the quality of their investor base. But the outcome for a lot of companies is dependent upon the strength of their investors and the ability of investors to get along with each other. And as you work through all of the challenges, you need to have investors that have the patience and the deep pockets to sort of weather some of these storms. But that has a huge difference on the outcome for these companies is the strength, the breadth and depth of the investor base. And then finally, execution. The biggest differentiator between the companies that succeed and the ones that don't are the ones that can execute on their plan and that have, walk before they run. I see, particularly when you get into the gold rush phase, you see companies rushing to try to get to market. They don't conduct adequate testing of things before they start manufacturing at scale. Then you get field failures, and you end up in a sort of a downward spiral. So having a really disciplined execution where you do things in the right sort of sequence that you've all learned about in engineering, in the engineering classes is, I think, really important. So now I'm going to talk specifically about some of the different types of financing sources and their attributes. So a whole bunch of different types of government loan programs, government grant programs. A lot of companies start out getting SBIR grants. Anyone here been through that process before? Well, these are grants that are provided by the Small Business Administration to help innovative technologies get hatched and move along. And it's not huge amounts of money, but 150, maybe 250,000 in a phase 1 grant, which allows you to begin to establish the technical merit and commercial potential. Your deliverable to the government out of this is essentially a report. And if they are happy with the process, then you may get a second grant, which gives you a little bit more money to continue your R&D efforts over the next couple of years. But this is how a lot of renewable energy technologies have gotten started, is with grants like this. And it gives you the chance to advance things to the point where you can convince an investor to risk some money on this. So it's not just something that you've done in a PowerPoint, it's something you can perhaps demonstrate. The DOE, National Science Foundation, Department of Defense, and so forth, at various times have different types of grants. So, for example, the Department of Defense may be very interested in having a jet fuel produced from renewable sources. So they may have grant programs, various sorts to advance that. The Department of Energy has a whole variety of grant programs that they have administered over the years. And the availability of these varies a lot on sort of where you are in the political cycle. So the President likes them, the Senate likes them, the House doesn't like them at the moment. So we'll have another election in November, and we'll see where we stand after that. That is one of the challenges of relying on that as a financing source. Most of these grants are awarded through a competitive process that involves review by independent expert panels. Some, particularly during the first few years of the Obama administration, there were a lot of these grant programs, and people seemed to feel like political influence would help them. So people spent enormous amounts of money on lobbyists to try to lobby these, and supposedly the decisions were all made by people that you couldn't even talk to. So I don't know if that was money well spent or not, but the lobbyists certainly convinced people that they had a lot of influence over that. I think at the end of the day, I rather doubt that. But anyway, that's sort of government grants in a nutshell. Any questions on that? Yeah.
Are these like DOE and NSF grants available to specific small companies?
Yes. Yeah. And they normally have specific technology areas that they're, well, the SBIRs may be available without necessarily a specification in advance of what they're looking for. But a lot of these programs, they'll say, we're looking to award a grant to companies that will do the following things for us. So my jet fuel example, come up with an alternative form of jet fuel. And
what's the overall volume of these programs in one ballpark?
So in the aggregate, it's tens of billions for individual companies. It can range from as little as $150,000 for a phase one grant to millions of dollars, millions or tens of millions of dollars. The advantage from an entrepreneur standpoint of these is you don't have to give up any of the equity in your company. So this is what's referred to as non-dilutive financing. You're not having to give away any of the stock in the company, or in essence share any of the future upside with the government in these programs. So I'm going to talk now about kind of the earliest stages of seed capital, and this is an equity investment, meaning that the investors take an ownership stake in your company in exchange for what may be hundreds of thousands or millions of dollars. It's rarely more than 3 to 5 million, and often less than that. This is money that may come from family, friends, other people in the community. As I think about some of the companies that have been financed in the Boulder area, initial capital came from some successful business people in the area that knew the entrepreneur that was starting the company, and when they heard about the idea, they said, geez, I'd like to invest in that. So they might write a check for $100,000 or $250,000 to have a piece of the company, and in exchange, they might get 5% or 10% or 20% of the company, depending on the amount of money and the valuation that the entrepreneur convinces them it's worth. Now, one of the challenges of relying on seed investors is lots of times they tend to assume that things are going to go really well. That's the dream they invested in. And when things don't go as well, they take longer, they take more money, then they may or may not have the willingness and appetite to write another check because the plan they signed up for initially hasn't been achieved. So that's one of the challenges in dealing with investors at any stage, is sort of satisfying expectations, but particularly with individuals that probably haven't set aside money to make subsequent investments. Now, as we'll talk about in a minute, when you're dealing with professional venture capital funds, when they make an investment in a company, they typically will reserve more money to come in later because they know the companies always need more money as they progress. So if you're a seed investor, what you're hoping for is that things will proceed according to plan, and that you'll, for a relatively modest amount of money, you'll have a significant ownership stake in the company, and if it's successful, you can turn your $100,000 into 10 times that. That's that replacing. And the downside from them is if it takes more time or money, then their stake may get diluted down because they have to raise more money and dilute their ownership stake, and they can potentially get completely wiped out. So, question in the back?
I just want to ask, in terms of seed capital, are you aware of crowdfunding having any influence on green projects?
So questions about crowdfunding?
Yes,
Yeah.
green projects.
Yeah. And I didn't even include a slide in it because I think crowdfunding is, it's gotten a lot of media attention. I don't think it's going to be a meaningful source of capital for renewable energy technologies, just because the amount of capital that's required is so significant. There'll probably be a few people that try it, and maybe a few people that succeed, but it's not the answer, I don't think. Notwithstanding some of the politicians that would like us to believe that it's going to be significant. So now moving on to venture capital. So let me tell you a little bit about who the venture capitalists are. So a typical venture capital fund is a pool of capital that might be $100 or $200 million that is managed by a handful of general partners. And the general partners are typically people that are experienced entrepreneurs or maybe experienced people from the investment community. And they basically convince the investors in their fund, the limited partners, to make a long-term investment with them. So these are commitments of capital that are made for 10 years. Investors can't pull it out. So they're basically betting that the general partners will be able to find some really good deals for them to invest in, and then we'll be able to monitor those investments. Most of the money that goes into venture capital funds comes from institutional investors, so it might come from endowments. The CU Foundation, for example, has investments in some venture capital funds, as do most universities. Pension funds, the Colorado pension, PARA, the California pension fund, all of those funds have big investments in venture capital. Comes from wealthy families. One of the first venture funds was started by the Rockefeller family. It's called Venrock. It comes from other insurance companies, folks like that. So and they're making these investments in the venture funds on the belief that skilled general partners will find some great investment opportunities, be able to get a significant ownership stake for not very much money. Facebook, obviously from different industry. Facebook, the initial investors put in probably less than $10 or $20 million and pulled out several billion in the IPO. So when it works well, it can be really nice. For every one of those, there's a lot of companies that don't know. Within the venture capital realm, there's different stages of investment. So we talked about the seed investment, which is kind of early stage, and there's some venture funds that do a little bit of that. There's an early stage where they'll get involved maybe after initial proof of principle at a bench scale, and provide the capital to scale that up to something more meaningful. We've got then pilot production, so once you've demonstrated something at a little bit bigger scale, there'll be venture funds that can provide greater amounts of capital for that, and then finally scale up. And once you get into the hundreds of millions, you're really getting beyond the realm of most venture capital funds. Oftentimes they'll come into an investment together. You have multiple funds in there, but in the aggregate, it's to be a rare deal where they have more than a couple $100 million in the deal. And the reason is that if you're investing a fund of a couple $100 million, you want to have a bunch of different investments. You want to diversify your risk, so they might be looking to put that in 12 or 15 different companies. So they generally won't want to put more than 10 or 20 million in a particular company. The venture industry doesn't fluctuate the same way the stock market does. It is still influenced by that. So basically, the venture capitalists are making a bet today that this company, based on some hopes and assumptions about what the market might look like in 5 years, and as the overall stock market goes up and down, their appetite for particular types of investments is certainly influenced by that, because that ultimately is how they get liquidity. So this gives a little bit of a feel for what's going on in the aggregate in the industry. So in the last few years, clean tech venture capital investment actually grew significantly. It used to, if we went back 10 years, there probably weren't even stats on this. But it's become a significant portion of the overall venture capital market. The amount that's been invested per year has grown from 4.6 billion in 2006 to I think the high point was in 2008, and then it dropped off after the stock market crash in 2008 and 2009. But it's been in sort of the $6 to $9 billion range. It looks like it's going to be significantly off this year, and I think that's a result of a number of things. The cheap natural gas has undermined a lot of the economic assumptions that people made about viability of business plans. You had changes in government policy regarding subsidies and so forth. There's a question as to whether the wind production tax credits reached that. All those kinds of things will tend to depress investment. Yeah.
I was just going to ask, are these figures the US?
Yeah.
It says global on
Hmm?
it. But it does say global on it.
Oh, it does? Okay. You're right. Okay, it is, all right, it is global. So the US accounts for the lion's share of this, but this is global. So. And then you see the number of companies this goes into. So it's ranged from 450 roughly in 2006 to, as many as 800. So you see, this amount of capital has been spread over quite a few companies. I think what's going to happen in the next few years is there's going to be a period of consolidation where some of the companies in which investments were made in the 2006 to 2009 timeframe, turns out that for whatever reason, either failures of execution or inability to compete at the current commodity prices, some of those companies will go by the wayside. So this is very typical of the investment cycles that have been seen in all sorts of other technology industries, whether it's biotech or medical devices or information technology, as you go through cycles of significant investment and then a winnowing process. And then hopefully the resources get concentrated on the survivors. And this gives you a feel for where the capital is distributed across different sorts of clean technologies. Probably the biggest variability has been in solar, where you saw a big spike up to about 37% of the total venture money in 2008, and that's dropped off now to just over 15%. Areas that are getting more attention are materials, transportation. So understanding sort of where you are in the cycle for a particular sector is important. So as companies progress a little bit further, they may be able to access private equity. And you think of that as, it's similar to venture capital. So again, these are pools of capital run by general partners that come from basically the same kinds of investors that come into venture capital funds. But they tend to have a little bit less appetite for risk. So they tend to invest in companies that have achieved some degree of commercial acceptance of the product. They're looking for a good return on their investment, but probably don't expect a 10 or 20 times return the way a venture capital investor might make. So they are basically taking less technology risk, less execution risk, they hope, and putting more dollars to work to finance scale up. Most private equity investors will only invest in revenue-generating companies, so getting to the point where you have a commercially saleable product where they can be satisfied that you've got something that has been vetted by customers is important. Because the renewable energy sector has grown up relatively recently, there aren't very many private equity firms that are focused purely on that area. I think that will be coming. In fact, I know Silver Lake is in the process of forming such a fund right now. But those that have invested here have basically sort of come from all over the place. So one that I worked with was a fund that was created basically by a very wealthy European family. And they've put a couple $100 million into one company because they thought that it had the potential to be the next for solar. Turns out they were wrong. This company filed bankruptcy. But those are typical source there. And then there's a few of them out there that represent sort of family, again, wealthy families who have an express social mission of wanting to invest in renewable technologies and maybe a little bit less focused on kind of the return on investment, and they're more focused on supporting companies. They still need to know that you have a viable business and a viable business plan, but there are some people who've made significant amounts of wealth in, let's say in Silicon Valley, for example, or elsewhere, who decided that they want to invest part of their family fortune in trying to address issues of global warming by making investments in renewable energy technologies. So now I'm going to circle back to what has in recent years been an important source of financing for some companies, and those are DOE loans. You've read about these in the paper if you've heard about Solyndra, because that one didn't turn out so well. Locally here, a local company called Abound Solar also had one of these, and they just filed for bankruptcy a couple of weeks ago. So this program had been quite important to a number of companies. I think it's been somewhat discredited in the public's eye and in Congress's eye by some of these failures. And I think it wasn't a particularly well-conceived program, because the idea was you were going to provide loans to companies to build their first commercial plant. So inherently, that's a risky undertaking. But they wanted to believe that there wasn't much risk there. So you're doing something that's inherently risky and then hiring a lot of consultants to write reports to convince the people making loans that it really isn't that risky, and it turns out that doesn't work too well. So it's not a very, I think the expectations of the program and of the program managers have not been very realistic about the risk that they're taking, and that leads to situations now where you've had some of these early failures, and you get the executives being dragged before Congress and grilled by Darrell Iss's subcommittee, and made to feel pretty uncomfortable. There's also overtones of political favoritism around this. So I don't know what the future of this is going to be, frankly. It's going to depend on what happens in the election, but I would guess that we're not going to see this as a significant source of financing in the near term. One could devise a loan program that would make sense, but I think it has to, there have to be some realistic expectations that if you're going to try to finance a first commercial plant, that you have some inherent risk of failure there. So I briefly mentioned strategic investors earlier. So these are the big commercial companies who have the capacity to take a new technology to market on a very large scale. So if you're solar, you do solar panel design, GE might be the company that initially partners with you and ultimately acquires you to take this to market. In the case of a new biofuel, it might be Total, the French energy company that initially partners, and they ultimately acquire a company that's developing a new form of biofuel. They play a very important role out there that even as some of the other capital sources have dried up, those companies have vast amounts of capital to deploy. But obviously they're only going to do it where they can make a profit. And again, the changes in the commodity prices can influence their appetite for this. To take another local example, ConocoPhillips was going to build an enormous training facility and research facility just 5 miles outside Boulder here. That was announced, it's a lot of hoopla a few years ago, and they've continued to delay that as I think changes in commodity prices and the overall environment have made pursuing renewable energy technologies less of a priority for them. They haven't said that, but I'm just inferring that from their behavior. And that's unfortunate, because that would have been a nice thing to have nearby here. One of the things that, well, lots of times the strategic investors will start out by taking a minority stake in a company with the intention ultimately of trying to acquire it down the road. So it gives them a chance to kind of go on a date before they get married. They often will initially co-invest with venture investors, and the venture investors are hoping that the strategic investor will ultimately buy the company and provide them with liquidity on their investment. Now, the strategic investors are an important role. They're not benevolent. They're in the business of trying to produce returns for their shareholders, and they will often try to seek advantageous terms in negotiating an equity investment where they might, for example, have a preferential right to buy the company. So there's usually some strings attached, and that's part of the way I earn my living is negotiating those agreements. Try to, avoid giving away too much. For companies that successfully develop the technology and get commercial traction, are able to begin selling it, they may be able to access the public capital markets by doing an initial public offering. And there have been a number of those in the renewable energy companies. One local example, a client of ours, is GEVO, which is developing isobutanol, which can be used for, among other things, jet fuel or blending into the gasoline produced using a recombinant production technology. The ability to access the public market really depends on the vagaries of the market and all the other things. It can be a good source of relatively low-cost capital. Once a company goes public, then it has to live in the public fishbowl, and every mishap or mistake can result in a big swing in the stock price. This will give a little bit of a feel for just how cyclical this market is. So you see, you go back to the first quarter of 2009 after the market crash, there were essentially no capital raised in initial public offerings. And this is global numbers. And then you see in the fourth quarter of 2010, there was actually quite a robust market. Right now, it's tapered off a bit. And then in the second quarter of this year, the only IPOs for renewable technology companies that occurred in the world were in China, and none in the U.S. So that illustrates the importance of China as a place for growth of renewable energy technologies and also the development of capital markets. Yeah.
Is Solar City going to be public this year?
They are. Now, they aren't developing technology,
Okay.
more in the deployment
Right.
stage, but they're planning to, yeah. And then there were a few companies that actually had to withdraw their IPO, so they weren't able to sell the stock. One of them was a local company, Luca Technologies, which had a technology to help production of natural gas by introducing microbes into wells, and they had some regulatory issues, but the rapid decline of natural gas prices, I think, also affected their plan. So they had to pull their IPO plans. So, and I will guarantee you, the investors who did that, made the initial investment in that company a few years ago, which include Vinod Khosla, who's one of the most famous clean tech venture capitalists, probably spent very little time worrying about the possibility that we might have $2 natural gas. It was just on nobody's radar. And one of the reasons why the public appetite for IPOs of renewable technology companies has faded a bit is because the stocks haven't performed very well. So people are less inclined to put money into sectors where the performance is like the market as a whole. And at some point, the prices get down to the point where people start coming in, they sense an opportunity once the price is correct. But at the moment, there's less appetite for that. So then you're going to just spend a little bit time talking about, given all this, why would anyone want to join an early stage company? And then I'm going to talk a little bit about some of the things you might look for if you examine opportunities like that. So if you're certain that you want to go work for GE for the rest of your life, you could go out and get a cookie now, because this is not going to be germane to you. But for hoping most of you will at least consider the possibility of going to work for a technology innovator, and give just a few thoughts on that. I think the first reason is just the ability to have an impact, to be part of the development of a technology that's going to make a difference in the world. And I think in this industry, like the pharmaceutical industry and many others, the innovations tend to come from smaller companies. You see people are able to do a lot of things with less money and less time in startup companies than would ever happen in a research department of a big company. Part of it is that smaller companies are able to attract a lot of very bright, creative, motivated people, and those people are the people who make things happen. I think there's also more of an opportunity for a significant personal contribution to this. You can have, if you're part of an engineering team of a dozen people advancing technology, you can have more personal impact there than you could maybe if you're working for a big corporation. And then, you might, if the company's successful, you might have a chance to actually generate some personal wealth by having an equity stake in the company. So most of these companies will offer some stock or stock options to the employees that join them early on. And it might be worth nothing, or it might be worth a lot of money if the company's successful. So if you're thinking about that, what do you look for? One is I think you want to ask some questions about the investor group that's supporting the company, because you want to know that they have strong financial backers that are really committed to this for the long term, and have the staying power to weather potential disappointments along the way. The quality of the team cannot be overstated, and it's not just smart people, but smart people that know what they don't know, and are willing to surround themselves with advisors and board members and so forth that can help them devise a sensible strategy. Given the vast amounts of money that have to be raised by these companies to execute their plan, it means having somebody on board that has a kind of foresight and vision to help develop a long-term strategic plan. So I have a number of clients that they're still in the development stage. They have zero revenue, won't have any for several years, and yet they have on board a fairly high-powered chief financial officer who has experience with public companies and with raising large amounts of money, because that's something that they're going to need to do down the road, and requires very careful, thoughtful planning to get there. I think you want to have confidence that you've got a very disciplined product development process. I've seen many companies get into trouble because they were in a huge hurry to get to market. And that's driven by all sorts of factors, but they didn't have the self-discipline to make sure that they had thoroughly tested the product before they started putting it out in the field. And once you start getting field failures, you embarrass yourselves in the eyes of customers, and customers may become ex-customers pretty quickly. A lot of it is, this is actually one area where you kind of rigorous process that big companies go through before they'll scale up and launch a product actually serves a small company well. So I think to be successful, you kind of need a mixture of the sort of the creativity and intense motivation and energy of the entrepreneur with the discipline of people that have scaled things up to very large level and done it in a very methodical, thoughtful way. A manufacturing scale-up plan that makes sure that you do things step by step, so that you haven't spent tens of millions of dollars developing a manufacturing line that has a flaw in it, and it takes maybe tens of millions more to fix. And then I think lastly, a commercial team at the company that really understands customers and how customers think and what's going to be important to the customers. So if I were going to look at joining a startup company, these are the kinds of questions I would be asking. And it's, it requires a little bit of skill to get answers to these things. It's obviously hard to ask some of these questions in exactly its terms in the course of an interview, but these are the things that I'd be trying to figure out. And that's all I have as far as my prepared presentation, but I'm happy to take questions. It looks like we've got about 10 minutes or so left here.
Well, first off, thank you for a great talk. And we have time for questions.
Yeah.
Sorry, just to take you back a little bit. This was probably earlier when you started. I meant to ask, but then, pieces along. In terms of moving
Yeah, there are programs of the federal government to export loan guarantees. Again, this is basically in the deployment phase when you've got a commercial product that's ready to sell. You may be able to get export financing on favorable terms through the Export-Import Bank to make it easier to sell those to foreign customers. And then there's also insurance, to the extent that a company decides to build a manufacturing facility overseas, they may be able to get political risk insurance through the Overseas Private Investment Corporation to protect them against the risk of things like expropriation, things of that sort. So those are two different programs that have been designed to facilitate exports or to protect people that have make investments in manufacturing abroad. Yeah.
Thank you for your presentation. I've seen that many companies have started as a spin-off from university. So I'm wondering, is there any incubation or support by universities for these companies, or they just started as SBIR?
Okay. It's a great question. There are, and we'll use the University of Colorado Boulder as an example since we happen to be here. First of all, in American universities, all of the technology transfer is handled through a technology transfer office. So under federal law, all of the results of all of the inventions that are made using grants from the federal government, which are a major source of financing support for the university, belong to the universities. Right? They don't belong to the federal government; they belong to the universities. And this was done many, many years ago because there was a belief that the universities would be more effective at licensing or spinning out the technology than the federal government might be as sort of a monolith. So companies here that, let's say a professor and some graduate students develop some new technology with some help from the federal government, the University of Colorado would own those patents and then would license those out to a company. A good example right here is OPX Biotechnology, which was started by Ryan Gill, who's a professor in chemical engineering. They've developed new means of producing acrylic acid through genetic engineering. That they licensed that technology from the University of Colorado, started a company, and got some initial funding from a seed fund in California. But as far as support for that, the Tech Transfer Office here has entered into a agreement with a group called the Innovation Center of the Rockies, which has a database of about, let's call it 1,000 subject matter experts that can serve as mentors, advisors, potential board members for startup companies. And so if the university has a particular technology that I think has commercial potential and that some, let's say, faculty members or graduate students are interested in building a company around, they would work with the Innovation Center of the Rockies to try to find some expertise there. And RACI also has some resources to help out. So, and many other universities have incubators or other things of that sort that are designed to try to help provide some of the support, because to launch a company, obviously you need to know science, but you also need some expertise in areas like finance and patent law and marketing and business plan writing and commercial production. So that requires a lot of help.
Thank you.
You talked a lot about the financial side, of course, and also the organizational side, like do they have a good team and stuff like that. But I was kind of missing the product side. I mean, is the product is there even a market for it and stuff like that? How do you figure that out?
Yeah, well, that's obviously critical, is that you have a good technology. But again, when you're starting a company, you think you have a technology that's going to be superior, but the whole point of that is to prove that through a series of experiments and scale up. So your hypothesis is that you've got a technology that is going to be superior to anything else on the market, and you have to go through this process to validate that your hypothesis is correct, that in fact it's going to perform better, and that you can produce it at scale at a reasonable cost. You know, the cost is going to be better than other available technologies.
Even if you have a great technology that works great, but nobody buys it because, I don't know.
But yeah, and that's why, you know, having on your team somebody with commercial experience who, you know, who thinks about those, you know, the market demand for things. So obviously, you know, you wouldn't form you know, a new company to sell buggy whips today, right? That market is somewhat gone.
Any other questions? Well, if not, thank you again.
All right.